Okay, good afternoon, everybody. I'm Sandy Chadha, I'm CEO of Supreme, and today we have also Suzanne Smith, who's the CFO, and Mike Holliday, who's joining us for the first time as the head of our vaping division. And I thought it'd be a very good idea to introduce now and again some of the heads of the division, so you can get a flavour of some of the other management team in our company. Next slide, please, Hannah. Yeah, so I'm not going to linger on too long here, but for those that don't know Supreme, Supreme is a fast-moving consumer goods business. We're a manufacturer, we're a licensee, we're a distributor, and we're a brand owner of fast-moving consumer goods, ranging from batteries, lighting, vaping, and wellness. We started our life in the early 90s as a battery distributor, and then moved into being a licensee in batteries. And then from batteries, we moved into lighting around about the 2008 with a license of Energizer, Eveready, and JCB. And in 2013, we moved into vaping. One of the interesting things about when we moved across different channels is that one thing in common is our customer. So our customer brings all our products together, and that's what's pretty unique about Supreme compared to other sort of businesses in the similar sort of arena. Can you please go to the next slide, Hannah? Thank you. Okay, so this is our vertically integrated platform, and this is what sets us apart from other people in our industry. So as you can see, we have a network of a system where everything is shared. So basically, we have a complete integrated platform where all our services are shared. So, for example, our lighting and our batteries and our wellness have the same warehouse, has the same sales team, has the same finance team, has the same buying team, and the same marketing team. So we have a very shared overhead base. So what this means is when we move into the new division, like we moved into wellness in 2018, there is very little overheads in moving into a new vertical. And all the overheads are really is the person or a couple of people that are heading up the team, but then they piggyback on the rest of these services that you see on this diagram here, and that's what sets us apart from everybody else in the industry. We've got over 4,500 live accounts. I would say over 500 of them by all our different product categories. So we are a very, very sort of a varied supplier to a lot of these customers. One thing being starting in the battery industry gave us a foothold into all these thousands of retailers because batteries were sold in more retail stores than any other product. Go to the next slide, please. Thanks. Yeah, I'm not really going to linger on here now. I'm really going to pass you over to Suzanne because a lot of these things that are on this slide, we're going to come to them in a bit more detail later. So over to you, Suzanne.
Okay, so let me take you through the financial highlights for this 6-month period. Revenue is up 6%, and the standout performance within our group this year, or this 6 months, has been vaping, arguably our strategically most important category and, of course, our largest category. Our vaping category has grown 47% year on year. Some of that has been driven through the M&A we've done in the period, but the lion's share of that growth has come from the core business, simply selling more products to more retailers and consumers. Sports nutrition has also grown 20%, and batteries have grown 5% as well. Lighting has had a setback, and that category has halved in the period, but as was well signposted already and shared with analysts, we knew that 6 months ago, and the category is already starting to see signs of recovery. What we have learned in the period is that this setback is almost certainly temporary, which is very reassuring. Elsewhere, from a financial perspective, our gross profit has moved from 30% to 28% as a result in a slight change of sales mix, increased volumes of purchasing from the Far East, and also some pressures with inflationary pressures within sports nutrition. And we'll get to the details of those as we do the category deep dives. Adjusted EBITDA is down almost 20%, and that arises for a few factors, and I'll take you through that when we get to the financial section. But it's important to remember that the 6-month period today is compared to a particularly strong period this time last year. We did more of our revenue and profit in H1 of last year than we historically have ever done before. Also, the period was marked by the 2 acquisitions that we did in the period, and it's important to note that both of those were earnings enhancing in the period as well. Elsewhere in the financial KPIs, we've seen here that the dividend policy that we changed in the summer is now reflected here. Our dividend policy has now moved to 25%, and combine that with a slight reduction in earnings has meant that our dividend is now 0.8p per share. We've also seen net debt increase in the period, exclusively arising from the acquisitions that we did in the period. Sandy, do you want to cover the operational highlights?
Yeah, so a lot of these things again are covered on later slides. We're going to cover the acquisitions that we made and the cross-sell across those acquisitions. And also we're going to cover off a little bit about the lighting and how that's now started to come back. And then we're finally going to end up on our new warehouse distribution centre, which we've just signed a 15-year lease. So we'll cover all these off in a bit more detail. And over to you, please. Thank you, Anna.
So the easiest way to explain the revenue and the EBITDA movements in the period is through the 2 bridges that you see on the slide here. So top left is the revenue bridge, and you'll see that the acquisitions have immediately added to our revenue growth, and they're the biggest green bar of all being the vaping growth, the organic vaping growth that Mike will take you through in some more detail. The important point to note at this point is that is almost all of volume growth as opposed to inflationary or price growth. And you can see also the growth in sports and wellness. And then, as I've just said on the previous slide, that the setback is exclusively down to lighting, and it's a temporary setback. I think compared to lots of other distributors and manufacturers supplying retail, as we are, and we're turning into kind of what will undoubtedly be a gloomy Q1 and possibly Q2 going into 2023, our setback is right here on this slide. That's £7 million setback for lighting. It feels like it's definitely behind us. The outlook, as you can see, for the remainder of the group has been a very stable and solid performance, and with the recovery of lighting now well on its track, then that revenue trajectory looks far more positive in the second half of this year and then on into the medium term. Similarly for EBITDA, which is the graph on the bottom right, you see there a step up for the acquisitions. Both acquisitions have been immediately adjusted earnings enhancing for the group. And we expect to make significant progress in the second half for both of those acquisitions. In the first half, they've been particularly cut size. The acquisition we did in August, it was running off its existing overhead base, and post period end, we have largely terminated that overhead base. We have closed out the 2 kind of London-based facilities that we're operating out of, and with the exception of 4 individuals, most people have been made redundant. That business has now been brought into the centralised platform that Sandy was referring to a little bit earlier, which means that their second half performance will be proportionately more earnings enhancing than the first. And then a similar story with Liberty Flights, into more at a kind of gross margin level. We are still underway with our purchasing synergies and allowing the Liberty Flights business to leverage off Supreme's purchasing power, and we'll see more of that in the second half, and also some of the onshoring of its manufacturing. So whilst it's made a great contribution in the first half, the outlook remains more positive for the second half. And you'll see that the organic vaping revenue growth that I just talked about has translated into organic EBITDA growth, and that gross profit has come through at around the 39% mark, which is the biggest contributor to EBITDA growth in the period. And then, as you'd expect, the setback we've had in lighting has translated into kind of EBITDA as well. Not forgetting that a lot of the category for lighting is sold on an FOB basis, meaning that we source the lighting in the Far East and the customer takes responsibility for shipping and clearance. And that means the overhead base for running that lighting category is very, very lean. In a kind of setback period where we are now, it means much of that gross profit translates into EBITDA, but as it recovers, we'll come back at the same magnitude. We have seen margin pressure in sports and wellness, well documented price increases, particularly for some of the core components like whey protein and creatine and soy. Some of those prices have increased 2, if not 3 times since the start of the calendar year. And whilst we have passed some of that on to the retailer and the consumer, we've also absorbed some of those price increases ourselves. Just like lighting, the trajectory, however, is much more positive. The prices are already starting to come down. We saw that in the latter half of this period, and we'll see more of it in the second half. So that feels very temporary in nature as well. And we've made some investments into the overhead base to support the inflationary increases, particularly when it comes to transport, fuel surcharges in the rates that you see across the transport network, and also some increases into our people costs as a responsible employer, given the economic climate at the minute with cost of living increase. Apologies. So our EBITDA has moved from 10.1 this time last year to 8.1 million. If we then move on to the income statement, and you can see how that settles into the wider income statement beyond EBITDA and below EBITDA, you'll see that depreciation and amortization has increased as a result of the increased intangibles on the balance sheet arising from the acquisitions. You'll see that we have increased our adjusted items this year, largely arising from the integration of both businesses that we have undertaken in the period. The lion's share of that really is the redundancy costs in Cuts Ice. And thereafter, everything flows through almost quite proportionately to the rest of the changes in earnings. If we then move on to the balance sheet, the shape of the balance sheet has changed quite substantially in the period. And that, again, is because of the acquisitions. We can see we've increased intangibles. There was an increase in working capital owing to the businesses as were inherited in the summer. Borrowings has increased exclusively and directly to finance the acquisitions. And you'll see that deferred consideration now lives on our balance sheet and will stay there for the next few months, owing to the structure of the Liberty Flights deal. As well as increasing our borrowings as a result of the acquisitions, we also consolidated our borrowings in the period after we took on our revolving credit facility. We had related party debt and some working capital facilities previously. That's now in one very flexible facility, our revolver, which means that we can repay or draw down on that facility as and when the business requires, which in a period of increased interest rates, that facility is certainly going to pay dividends for us going forward. The other thing to note is that kind of non-acquisition led investment into working capital was very negligible in the period, £500,000, which from period end to half year is quite unusual for this business, because usually we would be spending that time in the run up to September investing in stock to fuel our busiest period that then is ahead of us, October, November, December. We've worked really hard to tighten up the balance sheet with regard to debtors, creditors and inventories in the 6-month period. And you'll see that now as we turn the page onto the cash flow statement. So you'll see here, whilst EBITDA is down, our operating cash flow is up, which, as I said, is a nod to the kind of very tight way that working capital has been managed. We've repaid the final tranche of the related party loan notes in the period as part of that kind of debt consolidation. And we've also had negligible investment in CapEx into our plant and machinery, as we've put most of our sites now into a runoff mode ahead of moving into our new property. So a very healthy cash flow statement for the 6-month period. So if you just allow me to kind of do a final roundup of the financial performance by segment. 5% growth in batteries is a pleasing result for management. Still no COVID reset, and really does feel like it's bucking the trend in terms of what the larger market is doing. A disappointing but expected temporary setback in lighting, and the category is halved, and that category is now already resolving itself and recovering. And then 47% growth in vaping, owing to the acquisitions, owing to new product development, and the growth in the underlying hero products due to increased distribution. Sports nutrition has grown almost 20%. And whilst that has seen a reduction to gross profit as a result of the inflationary increases I just mentioned, the revenue growth means that as the category recovers in terms of whey price increases, it's very well positioned to keep hold of its market share going forward. And then the category we haven't spoken about, which is branded household goods, whilst revenue has reduced, it's held on to its gross profit position, and it's done that, its cash gross profit position, I should say, and it's done that with a rationalized stock holding, a smaller cost base. So whilst the revenue progression doesn't tell a progressive story, the overall margin and the contribution it makes to the category is actually strategically a lot smarter. It's a lot healthier. So all in all, a really solid and strong performance by segment, particularly when you bear in mind the temporary nature of the setbacks we've had this year.
Okay, moving on to lighting. If you could move to the next slide, please. Thank you. So lighting is an area where we have licensed brands. So we have a license for Energizer, Eveready, JCB, and these are worldwide licenses outside North America. So what we do is we go to China, we manufacture LED lighting for households and for businesses. We then pay a royalty to the likes of Energizer, JCB, and Eveready, and we ship it around the world. Half our business we ship around the world FOB. So we literally ship the goods and we get paid straight from China. And the other half of the sales come from stock that comes to the UK and then delivered centrally from our warehouse to lots of thousands of hardware and retailers across the UK. This business has been very stable over the last, 12 years, 10, 12 years. And as you can see, the growth has been quite consistent. Unfortunately, this year, we've had a decline, and that's partly down to two things: a consumer slowdown and overstocking in our biggest customers. The reason the consumer slowdown is because the years of COVID, there's been a lot more DIY, and there was some of the sales in 2021 and 2020 were probably slightly overinflated. But at the same time, that there has been a decline. So there's been a decline in the sales and also an overstocking by the retailers, which has meant that unfortunately our sales in this year have halved. However, on the positive side, this is starting to come back now, and we feel that it'll come somewhere in the middle of the two in this next 12 months and come back to the 27 million within the next 24 months, which means this will then come straight back to our bottom line profit like it had before. It's a great industry to be in, and we have just have to reconfirm to everybody on the call that we have not lost a single customer, and we've not lost a single listing or a single SKU in a retailer. This is purely down to economics, and unfortunately, some of these things are out of our control. So moving on from lighting, I'd like to ask some questions onto that later. We'll move on to the wellness category. The wellness category started in 2018, where we bought a manufacturer in Shannon in Ireland that went out of business, and we bought the assets for £100,000, and that set us into a new industry. We've grown the business very quick, as you can see on the graph below, until to this year, this half this year, 7.6 million opposed to 6.4 the previous year. Unfortunately, the gross margin has declined because of whey prices. So commodity prices in this area have more than doubled or tripled. The positive news is that these prices have now leveled off and started to decline, and new orders have been placed at 20% lower prices. We'll see some tailwinds in the second half of this year and then moving on to the year ahead. This is a great industry, and in this business, we manufacture our products, we manufacture our vitamins, we manufacture our protein powders. We also manufacture our meal replacements, and this is all done from Manchester, from our head office in Trafford Park. We also then have other brands in this area like Cymex, Battle Bites, Sea Lions, where we own or control very strong brands in the industry. I'd like to move on now to vaping, where I introduce you to Mike Holliday. Mike Holliday will take you through the slides on vaping.
Hi, good afternoon all. For those of you who haven't met me, as Sandy said there, I'm Mike Holliday. I joined Supreme in May 2013, where we didn't have a vaping division, so I've been there since day one. It's been quite an exciting roller coaster ride throughout, and it continues to perform strongly. So just to cover a few points on the screen there, vaping is now 67% of the group's gross profit. So something I'm obviously very proud of in how that's grown. But in terms of growth, I think the most important sort of numbers on the screen you've got there, we've seen 47% year-on-year growth the first half of the year from the vaping category. Now that's really been made up of three areas. 31% of that is organic. It's in-house brands that we've done really, really well with. And that's sort of split into two. We've got continued organic growth of our existing product ranges, whether that be through our 10 milliliter liquid products, which we manufacture here in Manchester, or our prison service accounts, our government accounts on the products there, which is performing very, very strongly. In addition to that, we've got new product development, which this sort of half has typically been disposable vape kits, which has come out of absolutely nowhere. The industry has boomed in this particular area. And then the final sort of third of the growth, if you like, has come from the acquisitions of Liberty Flights and Cuts Ice, which are really, really exciting propositions for the future. The gross profit growth of 36%. Now that is the gross profit for the first half of the year is down sort of 3 points against last year. We've gone from 41% to 38%. And that is really the blend of products that are sold there. So the new product development in the disposables, they're bought in items from China. We typically don't have quite as much control over the buying prices and the cost prices there. And we've also seen quite an investment into air freight to keep up with demand. Like I say, this product range has really come out of nowhere and developed very, very quickly. So to keep up with the demand, we've had to put a little bit more into the freight side of things than we would typically have liked to. Where does that leave us for the second half of the year? Well, the second half of the year for me is even more exciting than the first. And the reasons why I'm saying that, the two acquisitions that we've made, Cuts Ice, we brought in on the 8th of August. So we've actually only got sort of 7-8 weeks worth of Cuts Ice figures as part of these results. And of a similar nature, Liberty Flights was the 13th of June. So again, we've only typically got sort of 3 months, just over 3 months worth of figures in here for Liberty Flights for the second half of the year. And that new product development growth, which we've seen come out of nowhere, again, the second half last year, we didn't have at all last year, and we're already on a really firm footing for it this year to continue the growth we've already started earlier on in what we've done in the first half. So the second half of the year is looking very, very exciting from a vaping category point of view. Can we move to the next slide, please? So there's always an awful lot of questions that come up regarding vaping and what the regulatory landscape looks like, where the public health support comes from. And I think the really important take-home message from this slide and from this piece is we've seen no changes in the regulations whatsoever, nor is there any on the horizons with vaping from 2016 when the last set of rules were announced, which was the first set of rules. The TPD2, as it was then, or it still is in Europe, since Brexit has become TRPR, which is the Tobacco-Related Products Regulation. We've adopted everything as part of TPD2, and that was really there to ensure product safety, to ensure consumers were receiving safe, consistent products. That hasn't changed. There's been no tightening of the regulations there, and there's nothing on the horizon to suggest in any way, shape, or form it's going to be a threat to the industry. What's also important from this slide, and what's important for the industry in general, is the public health support that we get regarding vaping. It's phenomenal from the UK government. The figures are suggesting that quitting through vaping is the most effective quitting aid. It's more effective than inhalators, patches, gums, any other sort of off-the-shelf methods, or significantly better than going cold turkey for it. And that's backed up by the Public Health England, the National Health Service, Action on Smoking Health, Cancer Research UK. So the risk of vaping is very, very low, certainly compared to the public health support that we're receiving, which is very, very high. In fact, Britain's still committed to be smoke-free by 2030, and all of the tailwinds we've got right now are showing that vaping is going to be a huge part of allowing Britain to be smoke-free by 2030, showing vaping as the go-to to move away from tobacco-based products. And that's showing no signs of slowing down, and there's significant evidence out there to show more and more people are moving to vaping over tobacco products. Go to the next slide, please. Okay, so this is just a little bit of a summary as to where we are and what we've done. I think the important parts, a lot of which we've covered there already, but we've got over 1.2 million regular users of 88 Vape. So around about a third of the regular vaping marketplace is utilizing 88 Vape products. We're actually seeing this number grow still with the introduction of the new developments and the new product ranges. The product margin is holding very, very strong. The profit margin is holding very, very strong. And as I've already said, the sort of second half of the year is really positive. Just a couple of notes there on the acquisitions. So Liberty Flights really adds into our group in an area we've typically not been strong in vaping. So the convenience marketplaces is where they really operate. And it's something we've struggled with by being a value retail point with 88 Vape. Not all retailers want to take on that £1 product. So it gives us a whole new avenue to the marketplaces. In fact, between Liberty Flights' customer base and Supreme's customer base, so over 5,000 collective accounts, only one was in common. So it just shows how much more white space the Liberty Flights acquisition is giving us. It also gives us a head start in terms of a product range. Something that Liberty has been incredibly good at is a pre-filled pod system, what they call their Doc Pro. That's their hero product. And again, it's not something Supreme's really breached into particularly heavily beforehand. So the opportunities to grow with the cross sells for ourselves into Liberty's customers and vice versa gives us an opportunity to grow that brand and grow our brands in them areas. When it comes to the Cuts Ice side of things, Cuts Ice gives us a few new areas to be operating in. One is taking control of some of the supply chain. So Flavour Co, which is a flavour production house for e-liquids, came with Cuts Ice. We've now moved that into Manchester, and it's an absolute key area of the supply chain for the Cuts Ice products. And then Cuts Ice in itself, the majority of the Cuts Ice sales have been through Europe. Again, somewhere we've typically struggled to get a foothold in. So it's giving us that access into Europe. So whether it be France, Germany, Spain, Italy, where we've essentially bought into the supply chain, somewhere we've really struggled to penetrate. We've now got strong relationships. We've retained the Cuts Ice sales team, and it's a real opportunity to drive forward the Cuts Ice brands, but also the 88 Vape brand into the European footprint. And that's something we're already seeing. We've already taken some orders that we would have never taken beforehand for 88 Vape to come into the European footprint. So I hope that gives a bit of colour for the vaping side of the business. I'll pass you back to Sandy to touch on to a couple of areas.
Yeah, so moving on to the next slide. So Mike's elegantly already sort of covered the Liberty Flights acquisition, but just a few things that we do when we buy a business. Some businesses, we come in, we integrate it fully into Supreme, into our vertically integrated platform. Another business is where we feel there's a very strong management and a very strong business already. We tend to leave it running as it is, like we are doing with Liberty Flights, but we then support it with some of our purchasing power, some of our cross-sell opportunities into different customers and also products. For example, some of our new MPD disposables now being launched into the Liberty Flights brand, a brand called Moja, is now over 12% of their overall sales. It's something that we've introduced since we bought the business in the last few months. So this is the sort of thing that Supreme do really well. And I think one of the acquisitions, Liberty Flights, is opposites attract. There are a lot of things that they do that we don't, and vice versa, where I think there's a lot of opportunities in the future of cross-selling some of our products. Moving on to the next slide is Cuts Ice. So Cuts Ice, as we mentioned, was a business we bought in August. This is a business that we actually moved straight into our integrated platform. So this is a business that turned over in their year 10 million. And we have now reduced their overheads to virtually zero. They had £5 million of overheads a year. We've reduced those down to something like £30,000 a month. And how we've done that is basically we've got rid of 2 sites. We've got rid of the manufacturing and brought the manufacturing into Supreme's manufactured into our platform. We've actually made all the staff redundant bar for sales team. And we've basically integrated marketing, the back office, the credit control, sales support, all into the Supreme vertically integrated platform. So all the sales and gross profit of Cuts Ice falls straight to the bottom line of Supreme. In doing this process, we had to rationalize the range. We felt that the range was far too wide and broad, and we've reduced the SKU range from something like 1,000 SKUs to 100 SKUs, which means that we'll probably retain maybe 60% or 65% of the overall business, but it'll be a 65% manageable and very profitable. This brand, Red Astaire Tea Juice, is very popular in France and mainland Europe. It is probably the #1 recognized brand in France at the moment. So overall, we believe there is a good future in Cuts Ice and Red Astaire, but also at the same time, we believe that it's a very profitable short-term acquisition that fits really well into our platform, vertically integrated platform that we mentioned on the first slide. Moving on to the new site, Suzanne, do you want to cover that off?
Yeah, no problem. So you'll see here that post-period end, we've signed a 15-year lease for a new substantial facility, remaining in Trafford Park, so just literally half a mile down the road from our existing facilities here. But why the ARC is so important and why I wanted to share some details with you today was for a number of reasons. Signing ARC and moving into this facility will allow the business to continue to grow organically, because we were and are running out of space in our existing warehouses from a storage perspective, and also will allow us to do more deals just like the one Sandy's just outlined there with Cuts Ice, where Supreme identifies excellent brands, well-established, well-recognized brands with a loyal following that are housed in poor performing businesses, whether their overheads are too fat, whatever that reason might be. And those businesses sometimes go into financial distress, or worse still, go into administration. And what Supreme has done historically and sees it as this as a key pillar for growth in the future is that it goes and extracts those brands from those businesses and brings them back into the core Supreme platform. It can only do that when it has an expert resource base around it to integrate the business, but it can also only do that if it has enough physical space to do that. And signing ARC allows us to continue to identify those kind of M&A targets. ARC will also be a means for Supreme to consolidate. As Supreme has grown over the last few years and it has begun to run out of storage space, we have moved into smaller and shorter term kind of overspill warehousing facilities, just to deal with the excess of space we've required over and above our core facility. And that's helped us, and that's allowed us to continue to grow and keep up these kind of great customer service levels. However, it means that there are often times where we are handling the same product multiple times because we're moving it from one facility to another. And we recognise that that doesn't make for kind of optimal business planning and efficiencies. So ARC will allow us to consolidate some of those sites and reduce the movement and flow of goods through the business, and will mean we are much more direct. Products in, products straight out to customer. We can keep it nice and simple. It also will allow our people to consolidate and collaborate better in terms of, sharing office space. And we're also confident that because of the proximity of this new facility to our existing facilities, the disruption to our people, the disruption to our customer service levels, and even for our suppliers, in fact, all of our stakeholders, will be really minimal. We expect to be in occupation by the midpoint of next year. And we expect that our crossover and our kind of double rent and double running costs have also been minimized, I should say, because of how we've planned this from a timing perspective. And to give you a sense of of how much more space that this facility will occupy. As it says in the bottom right, there is a significant increase in the number of expected pallet spaces we're expected to generate. So whilst I suspect we'll continue to get questions this week about, so how much more revenue, it's hard to say. That would depend which part of our business generates the growth, but it gives us significantly more storage. And whilst there is a step up in the rent expenses, we know that that will largely be offset by the savings that we'll make in how we run the business from an overhead perspective, whether that's security or utilities or transport, and also the increased efficiencies we'll get from how we are handling goods. So definitely a milestone in the business's history. And also, I think, a very tangible signpost to the kind of confidence that the board has at the minute about the medium-term outlook for the business. I think for those of you that have followed Supreme from the start, you'll know that this is, we take a de-risked approach to investments and to growth historically. We're not renowned for opening big, shiny new facilities with rows and rows of new machinery. That's not how this business grows. It does it carefully, and it does it very cleverly. And so this marks a real confidence signpost in the outlook in terms of the growth that we expect to see and the certainty we have about lighting recovering and the rest of the business continuing to march forward.
Yeah, so current trading outlook. This business have been involved since early 90s. This is in that time, we've had consistent growth year on year for the last 30 years. We've only had 2 years that we've had blips, this being one of them. The future looks very positive. The vaping itself, I can't see anything that's going to slow it down, just carry on growing. And I see that the lighting and the wellness are going to come back. And then you're going to see, hopefully, a very strong 2024, 25. But let's see. I mean, we're living in very uncertain times with very uncertain economic conditions. But our products, Supreme's products, are all very, very strong. They are completely non-discretionary. I mean, basically, you have to go out and buy a vape or a battery if you need one. So we are in a very strong position. I'd like to thank you now, and we'll probably go on to some Q&A.
And can you share your average interest rate on debt?
2.5% over SONIA, so over LIBOR. Yeah, I wish 2.5%. 2.5% margin over base.
Given margin pressures, why haven't you put your prices up like every other FMCG business?
So where we have in some areas, so obviously wellness, vitamins, protein, we had no choice. We have to put them up. In batteries, they have gone up. In lightings, actually, our cost prices have come down because of the demand that's dropped off last year. On our vaping, we've not seen as much pressures really to warrant it. So the answer to the question is, we're a very transparent company. You know, we try to be as honest and fair to customers as possible. And if we've had increases, we put them up. If we've had decreases, we try and pass that on as well. And if we're sit here and trying to just take advantage of the situation when we're not necessarily disadvantaged, I'm not sure it's the right policy of Supreme. I'm not saying that wouldn't change for the future, because we're going to have other inflationary pressures of, you know, the new warehouse, the cost, and of course we'll have to look at that.
Okay, thank you. And I guess leading on from that, the comment is there is some views that very low prices put people off, as they think a cheap price equals a cheap product. You know, is there an argument for putting prices up to raise the sort of brand profile of your products?
Yeah, so we're known as a sort of budget brand entry price point. So for example, 88 we sell the product at £1, but we have 1.2 million regular users every month. So, you know, we've been putting the price up to 1.2 million people, and they're all happy with the product because they're buying it week in, week out. I don't think that, I'm not sure that the right argument is to put the price up to make our brand look better. I think we can do other things to make our brand look better in terms of the quality of the product being spot on, having zero, I read every single complaint in the company about our products. I want to know if there's anything wrong. So we need to make sure our products are talking and our price is the best. And we've always been at the sort of entry point, the bottom point of the market.
Okay, some questions on vaping. This might fall to you, Michael. There's a growing movement to ban disposable vapes, both on the grounds that after use they're not disposed of properly, causing an eco problem, wasting lithium, even causing fires, and on the grounds that their day glow highlighter style packaging are attractive to teenagers who have never smoked. If a ban were to be imposed that to get rid of day glow style packaging, a ban would be imposed, would the company lose out, or would it benefit from a switch to higher margin non-disposable vaping?
I think right now we're seeing more adults still transferring over from tobacco products into vaping than we've seen before. And disposables have been an attractive way to get into the marketplace, where we've seen very little barrier to entry. You know, an understanding of the product is very, very simplistic. You just pick it up, grab and go. So there are benefits to the disposable marketplace, where it's getting people away from tobacco-based products. If it came down to looking at, you know, sort of banning disposables because they are attracting, you know, a younger audience, or whether it comes down to the single-use battery side of things, single-use batteries should be taken care of by battery compliance schemes, which we're very much a part of. We've been part of for years, which takes into account the disposal of single-use batteries. So that is under a little bit of scrutiny for the marketplace, because not everybody in the marketplace is involved in such a scheme, which they really should be. So from the lithium side of things, the battery side of things, that really should all be part of recycling, and it should be part of battery compliance schemes, which we're all part of. When it comes down to the colour side of things, or how attractive the packaging is to a younger audience, people are attracted to different things. It would be wrong of me to sit here and say there is nobody of a younger audience that have picked up a disposable because they think it's on trend. But in reality, they are there to stop people moving on to tobacco-based products. If they were banned outright for whatever reason going forward, there would be a small level of drop off in terms of the amount of people using them. But as you said there, people would then move on to higher margin products when it comes down to open-based systems, liquid-based systems. So there's an argument one way, there's an argument the other way. We believe they're here to stay, at least for a foreseeable future. And we're also working very heavily in research and development and new product development behind the scenes to look at similar sort of look and feel for the simplicity side of things for the new vapor, yet using reusable batteries, rechargeable batteries, so somebody can still get the same look and the same sort of feel and the same simplicity from a product without the single-use batteries and without that connotation of waste.
Okay, what's your market share in each of the vaping categories, and how have these changed in the past year?
So on the open system side of things, when it comes down to liquids and 10 mLs, we believe we're in the sort of low 30s, around about 33% market share. So we think about and that's in terms of volume. You know, I must stress in terms of volume, as a value brand, to have that sort of value in the marketplace would be a challenging number to manufacture that many e-liquids. When it comes down to the disposable side of things, it is hugely led by one particular brand, and I'm sure it'll come as no surprise to some of the people on the call here. That's Elf in the UK. They're absolutely dominating the majority of the marketplace. It's very early days within disposables to have true figures as to who's doing what. So it'll be very hard to say. How I would look at that is the majority of our retailers that have been taking our 10 ml products are also taking on the disposable products with them as well. So it's getting more shelf space for 88 Vape, and we're getting more and more listings along the way with 88 Vape as well. So we may not be dominating the disposable marketplace like Alpha, but we're certainly growing in line with the market.
Thank you. The manufacturing of 88 Vape, the disposables are made in China. Does that mean that you make the liquids in Manchester, ship them out, and then ship the whole lot back prepared?
I think we're on the formulations, Hannah, they're made in China. So some things we do send our liquids out, like some of our pods and our prisms and stuff. And some of the disposables are made liquids in China, but based on our recipes and formulations that we own.
Okay. Has the Flavour Core business relocated to Trafford Park?
Yes, it has.
I think that's most. Let's move on to sports nutrition. Of the revenue growth, how much of the 19% revenue growth can be attributed to volume and price respectively versus comparative periods?
So you talk about inflationary price going up, you mean?
Yeah, they're pointing to the revenue growth, so I guess top line.
Yeah, I am pretty confident that all the growth is inflationary on the revenue. I think our volumes are probably the same as they were before. It's just the price has gone up. But we're saying that why it's good is because I thought when the prices go up, our sales would drop significantly, and they haven't done. So I think there is. But the second half of this year, we think that the volumes will increase, as well as the price staying where it is now, but hopefully making a bigger margin.
Okay. Well, that kind of leads into this one. It's good to hear optimism is returning. How long will it be until you recoup that lost gross margin? And can you envisage an on-shelf price getting back to 21 levels?
So we're talking about, well, there's two areas that we've lost out, is the lighting, the FOB, which...
Sorry, this was in regards to sports nutrition.
Okay, yeah. I think the second half will be substantially better than the first. And then if the prices deflation carries on as they are now, then it should get, the second half of next year should be back to where it was. But again, I don't have a crystal ball, unfortunately, and I'm not sure what's going to happen with inflation. As long as inflation's in control, as long as the prices start leveling off and going down, I think we're in a really good position next year. And with our new manufacturing moving, giving us a lot more efficiencies, I think we're in a really strong position.
Okay. Sandy, you mentioned Cymex is one of the two most exciting acquisitions in the company's history. Can you explain this statement and discuss the vision for it?
Yeah, so where we bought with Cymex, for example, we paid £1 million for the brand. It'll generate in the year today, I'm guessing it's going to generate something like 1.5 million to 2 million gross profit a year for us as a company. It's giving us a brand that's opened doors into Tesco's, Morrison's, Sainsbury's, where we didn't, and Costco now, and Amazon, where we didn't have those customers before for wellness and protein. We took on no overheads, we took on no staff. We literally took their product and brought it into Manchester, and now we are starting to manufacture all their products in Manchester ourselves. So in terms of, we've got a brand that's well recognized, we've got customers that we never had before. We only paid £1 million for it, and it should bring £1.5 million of the gross profit a year. For me, is a great deal, a great achievement. And the same with the cut size, very similar sort of thing with different numbers, but very similar sort of cost to buy the business. But the rewards on the other end are great. But there's always a risk when you buy a business, either for administration or distress, that how many customers you leave, how much tarnish has a brand had. There's a lot of risk involved, but that's all reflected in the price that you pay for it.
Okay, a couple of questions on European expansion in vaping. Can you give us colour on your plan and specific countries that you're focusing on?
So I'll let Mike explain that with T-Juice.
So T-Juice is stronger in Europe than it is in the UK, which is one of the things that attracted us to it in the first place, because it's somewhere that we haven't really expanded particularly hugely in from an 88 vape side of things. It's actually the most popular, or the best selling flavour of e-liquid in France is Red Astaire, which is part of the T-Juice range. So we've got very, very good avenues from a vaping side of things now to go through the major distributors in France, particularly. It's where T-Juice is at its strongest. We've kept the T-Juice sales team, so we've got avenues to market, relationships and history with them customers now through the contacts we've got in the sales team. So we're actively looking at France, and we have had some success in cross-selling 88 vaping already with some customers there through the sales team over there. And we are looking into changing the packaging that we've got on certain areas for Germany, because they've got a new taxation legislation, which means we're going to have slight changes in packaging there. So Germany we're actively pursuing, and also Italy and Spain are the first sort of countries we're looking into. Purely and simply, they are the bigger vaping regions in Europe to try and hit first, and that's also where we've got the best representation in terms of a sales team.
Are you currently selling to B&M across Europe or just UK?
So Europe, B&M have only got another chain in France called Babu, and yes, we sell to Babu as well on our lighting and battery products.
Not vaping yet. I've read something in the news a couple of days ago about a proposed hefty increase in tobacco and vape taxes in Europe. How could these impact you?
Yeah, currently it is just headline figures. So it's been discussed at the moment. There's nothing in terms of any change of legislation on the horizon anytime soon for that. Some countries in Europe, as I've already mentioned there, Germany are already taxing vaping reasonably heavily. Italy's been taxing vaping for some time as well. So depending on what the levies could potentially be, may change the product mix that people run to, not necessarily moving away from vaping. So in Germany, as an example, people are transferring onto smaller unit sales in terms of the amount of milliliters that they buy at any one time because of the taxation per milliliter. So it's very, very hard to say without, you know, legislation in the pipeline and knowing exactly what it's going to look like. The TRPR, the UK is very, very separate from that, which currently there's no discussions for, where the majority of our business is. Should it be something that's introduced in Europe, we'd have to see exactly what the outlines are to try and react to it. But that's in time to come. There's nothing we can particularly work on at this moment.
Yeah, as Mike said earlier, the UK government is very supportive of the vaping, and they've got a 2030 policy of smoke-free Britain. They're still working towards that. So this would be sort of like a reverse gear if they were still thinking of the 2030 policy.
Fine. Little clarity requested here on margins. Michael, you mentioned that gross margins on disposables are the reason for lower margins in vaping this year, but they understood that Sandy said previously that margins on disposable were particularly high. Can you?
I don't remember saying that ever. Sorry, no, margins are definitely lower on disposables. If I did, it was a mistake. I'm so sorry, but no. Margins on disposables are lower than our homemade products in the UK for sure.
Good. These events provide clarity, so we've done that. Any legacy lease costs for the redundant Trafford Park sites?
It's less than a quarter of a mile away, so I don't think we need to. I think everyone's happy to move.
No, I think the question is around kind of crossover of lease costs.
Yes, please, Suzanne.
So yeah, there are periods of double rent. On a cash basis, when we move into ARC, we will simultaneously be moving out and handing the keys back to the principal site that we've currently got today. So for the biggest sites, by design, of course, these two are neatly there's almost no crossover, maybe 8 weeks in terms of physically being fit out, ready to go. Helpfully, the first 12 months of ARC is also rent free. So on a cash basis, it's the opposite. There's not a crossover. In fact, there's a gap. However, on the more supplementary sites, the smaller sites that we've been in for just a few years, where we've been kind of the overspill of our kind of reaching capacity, there is some double rent for those two facilities. And we're already exploring subleasing those facilities to try and minimize the kind of cash exposure. In any case, if it does result in a double rent situation, we will neatly adjust out that double rent impact, and we will be reporting on a kind of go forward overhead base. Of course, we'd see it in the cash flow, and we'll minimize it as best we can, but it's already set up to be fairly minimal exposure, given there'll be other businesses that have 18 months, 2 years of crossover, whilst they are, you know, just timing hasn't allowed. But yeah, this is falling into place really neatly.
Okay, thank you. Well, I've got you, Suzanne. Just obviously you touched earlier on the interest rate on debt. Is there any other detail you can provide around finance in terms of current length of facilities, etc.?
Yeah, so at the start of this financial year, we refinanced all of our borrowings into one single revolving credit facility, a £25 million facility. So at the time we had a related party loan, we had some working capital facilities, and we had a term loan, and we put all of that together, most of which I think we had about £4 million of net debt by year end in March. So there wasn't a great deal to consolidate, but it was more the actual facility of financing acquisitions on the fly, because we typically identify businesses and move through kind of deal execution very quickly, and we didn't want to be in a position where we were kind of figuratively waiting in line at the bank for kind of credit to authorize borrowings. So having a revolving credit facility effectively on tap was absolutely the right facility in terms of flexibility for us. It also means in the reverse, when you are then repaying the borrowings, you're not fixed to kind of term loan quarterly repayments. We can repay these, we pay down these facilities as soon as we have the kind of free cash to do so. And given where interest rates are moving currently, that's certainly a priority right now. So yeah, we have one single principal facility. It's a £25 million facility. It's 3 years. We are 6 months into it. There's a further 10 million available to us on accordion on this under the same facilities agreement. Do I anticipate us capping out the 25 or drawing down the further 10? No, because this business has historically had a very low and kind of de-risked approach to kind of levering up the balance sheet. We're currently borrowing the equivalent of 1 turn of EBITDA, and I don't see that changing in the short term unless an absolute kind of golden nugget of an M&A opportunity comes across our desk over the next 6 months. I think actually it was more about generating cash to pay down some of these borrowings over the next 6 months.
Okay, are you all right to carry on taking questions? I'm aware.
Yeah, I've got a few minutes, no problem.
Debt seems to have increased significantly. Is this owing to M&A or other contributing factors?
M&A plus as in day one purchase price and integration costs relating to M&A, nothing else.
Okay, any concern that you have across all of the divisions in terms of your exposure to China and trade wars, etc.?
With very low exposure to China. I mean, most of our products are 65-70% of our profits come from products made in the UK and don't have any source from outside Europe, mainly all UK really.
It's a good time to be quiet on lighting, because that was the principal kind of driver of Far East source products, and of course we're not sourcing that much of that right now.
Again, division by division, can we take a look at input costs and inflation going forward? Where are your big concerns?
Today I've got very little concerns about the next 6-12 months compared to the last call we had, for sure.
Any key themes you want to pull out on sustainability trends at Supreme?
I think rather than dredging all of that up and keeping here, actually what I would do is signpost everyone to the annual report, because there was a really comprehensive section in the annual report we published in the summer covering all of the ESG initiatives that we'd undertaken in the last financial year. There isn't a great deal more to talk about since then, so I would direct someone to go and have a read of this section. Okay.
And can you please hold the AGM a little later than 8 o'clock? It's hard to get there at that early hour. Well, you will take that all on board.
Okay. We'll consider it.
I think that is probably it then, because I think the rest of these we've covered in the round. So thank you all, 3 of you.
Thank you very much.
Mike, for the answer to those questions, and best of luck. We'll catch up with you in 6 months' time.
Thank you, Hannah. Thank you, guys.